Donald Trump just signed an order that tells me something very important about how money is going to move next. Most people will look at the headline and see politics. That is not how I look at it. I look at it as a flow of capital. I look at it as a machine. I ask where the pressure is building, where the bottleneck is forming, where the government is being forced to spend, and which companies sit directly in the path of that spending. Right now, the biggest bottleneck is not the AI chip. The biggest bottleneck is power. Everyone is watching NVIDIA. Everyone is watching the software companies. Everyone is watching the visible part of the AI boom. But the less visible part may be even more important, because the less visible part is the physical system that allows AI to run it all. A data center is not an idea. It is not a press release. It is not a model on a screen. It is a physical machine that consumes electricity every second of every day. And the American power grid was not designed for this. It was designed for a different age. It was designed for refrigerators, air conditioners, factories, homes, and ordinary industrial demand. It was not designed for a world where data centers run AI workloads around the clock and consume power on the scale of entire cities. That is the reality most investors still have not absorbed. AI is not just a technology story. It is an energy story. It is an infrastructure story. It is a grid story. It is a capital spending story. And when I see those things come together, I pay very close attention. Because when a major trend becomes unavoidable, money does not move randomly. It moves through the system in a sequence. First, the problem becomes visible to institutions. Then the money begins moving before the public understands why. Then policy catches up. Then the headlines arrive. And finally, retail investors notice by the time most people reach the last stage, the first stage of the opportunity has usually already moved. But that does not mean the entire opportunity is gone. It means you must understand the structure clearly enough to know whether the money is still flowing. That is the key. The American grid is old. The transformers are old. The transmission system is old. The approval process is slow. And the demand curve is suddenly changing faster than the infrastructure can handle. That mismatch is what creates opportunity. If a data center needs power now, but a grid connection can take 5 to 10 years, the data center owner cannot simply wait. AI does not wait. The competitive race does not wait. The capital commitments do not wait. The companies building these systems need power faster than the traditional utility process can provide it. So they begin to do something that would have seemed unusual at this scale not very long ago. They build or secure their own power. They go off grid. They sign power purchase agreements. They look at fuel cells. They look at natural gas generation. They look at small modular nuclear reactors. They look at anything that can provide reliable power at the scale and speed required. That is not a small change. It means that large technology companies are starting to behave, in part like utility companies. It means energy infrastructure is becoming part of the AI supply chain. It means power is no longer a background assumption. It is becoming a strategic asset. And when something becomes a strategic asset, capital follows. The new order on grid reliability and security matters because it confirms what the market had already begun to recognize. It gives emergency authority to keep capacity online. It supports the protection and expansion of critical power systems. It strengthens the idea that the grid is not optional. It is national infrastructure tied to economic competitiveness, military readiness, and the next phase of technological growth that tells me the spending is not likely to be small. It tells me this is not merely a one-quarter theme. It tells me that the companies positioned around power generation, transmission, grid construction, cooling, components, uranium, aluminum, copper, and data center infrastructure may be standing in front of a multi-year wave of capital. I do not look at that emotionally. I look at it mechanically. When I was building Bridgewater, I learned that most people form opinions first and then look for evidence that supports the opinion. That is a dangerous way to invest. A better way is to examine the machine. Ask what is happening, why it is happening, who must respond, where the money must go, and what would have to be true for the thesis to be wrong. In this case, the machine is straightforward. AI needs power. The grid cannot supply enough of it quickly enough. The government cannot allow the grid to fail. Data centers cannot wait. Utilities must upgrade. Contractors must build. Component suppliers must provide the equipment. Raw material producers must provide the inputs. That is the chain. And once you see the chain, you can begin to identify where the money is flowing. The mistake most people make is that they start with stock names. They ask, what should I buy? That is usually the wrong first question. The first question is, what is the environment? The second question is, what pressure is the environment creating? The third question is, which sectors are receiving capital because of that pressure? Only then do I look at companies. If you reverse that order, you become vulnerable to stories. You hear a ticker, you hear a narrative, you see a chart that has already moved, you get excited. And you mistake excitement for analysis. That is how most people lose money. The better process is to follow the money. That phrase is simple, but most people misunderstand it. It does not mean follow gossip. It does not mean follow what an analyst says might happen. It does not mean follow a politician's speech. It means observe where capital is actually going. When broad indexes do very little and a narrow group of industries rises dramatically, that is information. If the SP 500 is barely moving while power line construction, engineering and construction, electronic components, and certain power infrastructure stocks rise sharply, that is not random. It is the market voting before the public narrative is complete. Money moved before the story became obvious. That is what sophisticated investors watch. They do not wait for the television panel to bless the theme. They watch contracts, backlogs, order books, relative strength, capital expenditure plans, and sector rotation. One of the most important words in this entire story is backlog. A backlog is not hope. It is not management enthusiasm. It is not a projection designed to impress investors. A backlog is work that has already been sold. It is contracted revenue that a company expects to execute over time. And in infrastructure investing, backlog is extremely important because it tells you whether the demand is real. A company with a large and growing backlog is not simply saying that a trend may benefit it. It is showing that customers have already committed money. That is why a company like Quanta Services matters in this discussion. It builds transmission lines, it builds substations, it does the unglamorous physical work that the grid requires. And when a company like that has a backlog measured in tens of billions of dollars, I do not dismiss that as a small data point. I treat it as evidence that the spending cycle is real. The most important opportunities are often boring on the surface. Power lines are boring, substations are boring, switchgear is boring. Transformers are boring, cooling systems are boring, fuel cells are not as exciting to the average viewer as a new AI model. But in markets, boring can become very profitable when boring becomes scarce and necessary. That is one of the principles I have learned over decades. The world often rewards the people who own or finance the bottleneck, not the most exciting story. The bottleneck during a gold rush, the most dependable money is often made by the people selling the picks and shovels in the AI power build-out. The picks and shovels are not only chips, they are also power generation systems, grid contractors, electrical components, cooling systems, and the raw materials required to build the infrastructure. The first major theme is off: grid power generation. This is where the pressure is most immediate. If a large technology company needs a new data center, it cannot always wait years for a traditional grid connection. So it searches for on-site or dedicated power that creates demand for companies that can provide power close to where it is needed. Bloom Energy is one of the names that fits into this part of the structure because it provides fuel cell systems that can generate electricity on-site. The important point is not merely the stock price, the important point is the function. If data centers need reliable power and cannot wait for the grid, companies that provide on-site power become strategically more valuable. When Bloom signs a major deal with a large technology customer, that is not just a company-specific event. It is a sign of the broader pressure in the system. The second part of off-grid power is nuclear. Nuclear has a complicated public history, but the investment logic is simple. Data centers need reliable power that does not depend on sunshine or wind. They need power at night. They need power during storms. They need power during peak demand. They need power with high uptime. That is why small modular reactors have become part of the conversation. Oklo is one of the names associated with that theme. It is not the same kind of company as Bloom Energy. It is tied to the nuclear side of the power problem. The thesis is that smaller nuclear systems could provide dedicated power for the facilities that need reliability and scale. Of course, early-stage nuclear carries risk. It has regulatory risk, execution risk, timing risk, and public perception risk. But from a systems perspective, I understand why large companies are looking at it. If AI demand keeps growing and grid connections remain slow, the search for reliable on-site power becomes more urgent. Nuclear can become attractive not because it is fashionable, but because the system needs dependable capacity. And if nuclear power demand grows, another part of the chain becomes important. Uranium Camco is one of the major uranium suppliers in the world. The logic here is the classic picks and shovels logic if more reactors are built or if existing nuclear capacity becomes more valuable. The input required by reactors becomes more important. The supply side matters because uranium production was not aggressively expanded during the years when nuclear was unpopular. When a long-neglected supply chain suddenly faces renewed demand, prices and margins can change quickly. This is why I never examine a company in isolation. I examine the chain. AI demand pushes data center demand pushes power demand pushes on-site generation and grid expansion. Nuclear demand pushes uranium demand. Each step has its own risks, but the relationships matter. The second major theme is the physical grid builders. These are the companies that build the infrastructure most people never think about until it fails. Transmission lines, substations, power plants, gas pipelines, electrical systems, and construction capacity. Quanta Services sits near the center of this. It has scale, it has a large backlog. It is positioned in North American grid infrastructure. When the country has to expand and repair transmission capacity, a company like that can receive a large amount of work. Mastech is another name tied to this theme because it builds power lines and pipelines that matters because gas-fired generation still plays a role in grid reliability. Whether people like it or not, if data centers need constant power, intermittent energy alone is not enough. The system still needs dependable generation and the infrastructure to move fuel and electricity. Argon is tied to power plant construction. When capacity has to be built or maintained, companies that can design and build power plants become part of the spending chain. Comfort systems is tied to mechanical and electrical contracting, including the systems needed in data centers. That matters because building a data center is not simply buying chips and putting them in a warehouse. It requires electrical work, cooling, mechanical systems, reliability, redundancy, and execution. These are not glamorous businesses, but they are essential, and essential businesses can become very valuable when the system is forced to spend money on what they do. The third major theme is components. If grid construction is the pick and shovel play on AI, then components are the pick and shovel play on the grid build-out. Every data center, substation, transmission project, and power system needs specialized pieces, power modules, switchgear, circuit boards, cooling systems, electrical distribution equipment, transformers, and related components. These are not always easy to make. They can have long lead times, they can require specialized knowledge, and when demand suddenly accelerates, the companies that can deliver these pieces can gain pricing power. Vicker is one example because power conversion is critical. Chips and systems require power to be transformed and delivered in very specific ways. As power density rises, the importance of high-quality power modules rises with it. Powell Industries is another example because switchgear and electrical distribution equipment become more important when electricity has to be moved, controlled, and protected. If power demand increases sharply, the equipment that manages power flow becomes more valuable. Vertiv is tied to thermal management and cooling. This is one of the most important practical problems in the AI infrastructure. Boom, AI chips run hot. Dense computing environments need specialized cooling systems. Traditional approaches may not be sufficient as power density increases. When computing intensity rises, heat becomes a constraint. And when heat becomes a constraint, cooling becomes part of the bottleneck. That is why I look at cooling not as a side issue, but as part of the core infrastructure problem. TTM technologies and advanced energy industries also fit into the broader electrical and components layer. The details differ by company, but the structural point is the same. The build-out requires a supply chain. The supply chain has bottlenecks. The bottlenecks can become investment opportunities. The fourth major theme is raw materials. The grid cannot be rebuilt with speeches. It has to be rebuilt with physical inputs. Aluminum for transmission lines and conductors, copper for wiring, transformers, and electrical systems. Uranium for nuclear fuel. Those inputs matter because infrastructure is physical. If the government wants domestic rebuilding and tariffs favor domestic production, domestic suppliers can become more strategically important. Century Aluminum is one example of a company that has already moved substantially. When a stock has already moved a great deal, risk management becomes more important, not less important. But a strong move does not automatically mean the move is over. Trends tied to large capital cycles can run much longer than people expect. Alcoa is another aluminum-related name that may offer a different setup depending on price, positioning, and market behavior. The point is not to chase every raw material stock blindly. The point is to understand that a grid rebuild requires inputs, and input suppliers can benefit when demand rises faster than supply. Now, many investors hear a list like this and make the wrong move. They write down tickers and buy something because it sounds exciting. That is not what I would do. I would build a process. A good process begins with the undeniable trend. Not a prediction, not a wish, not a promotional story, an undeniable trend. In this case, the undeniable trend is that AI power demand is rising. The grid is old. Data centers need reliable electricity. The government is responding. Private companies are responding. Capital is moving. That is the macro level. Then I would ask which sectors are directly in the path of the money: off-grid power generation, grid construction, electrical components, cooling systems, raw materials. Then I would look inside each sector for the companies with evidence: backlog, contracts, relative strength, revenue visibility, institutional accumulation, pricing power, execution capability. Then I would consider risk. How much has the stock already moved? How cyclical is the business? How dependent is it on one contract? How strong is the balance sheet? What can go wrong? What is already priced in? What would change my mind? This is how I try to think, not with certainty, with probabilities. Many people think investing is about predicting the future. I think that is only partially true. Investing is more about understanding how the present is evolving and then positioning yourself in ways where the odds are favorable if the machine continues to operate as expected. You do not need to know every detail of the future. You need to know where pressure exists, where money is flowing, and where the market has not fully processed the implications. That is why being a little late is not always bad. A lot of retail investors have been trained to believe they must be the earliest person in every theme. That is dangerous. Being too early can be the same as being wrong if the capital has not yet started to move. A theme can be correct for years before the market rewards it. Institutional investors often prefer confirmation. They want to see the money begin to move. They want to see contracts. They want to see backlogs. They want to see relative strength. They want to reduce the chance that they are funding a dream instead of participating in a trend that does not eliminate risk. Nothing does, but it can improve the probability of being right. This is why I care about sector rotation. The market is not one thing, it is many things. Money moves from one part of the system to another. One month, the visible story may be chips. Another month, the money may be moving into power equipment. Another month, it may be moving into uranium or construction or cooling. If you only look at the broad index, you miss the internal motion. The index may be flat while certain sectors are rising dramatically. Most people feel frustrated because they think nothing is happening. But inside the market, capital is rotating. That is where opportunity can exist. The grid story is a good example. The broad market may do very little over a period, while the companies tied to grid build out, electronic components, power infrastructure, and off-grid energy rise substantially. That is the market telling you something. It is telling you that the money is not absent. It has moved. The question is whether you are watching the right screen. I have seen this pattern many times. The public asks whether the market is too risky. The institutions ask where the risk is being rewarded. The public asks whether a headline is good or bad. The institutions ask what contracts are being signed, what backlogs are rising, and which sectors are showing relative strength. Those are different questions. Different questions produce different outcomes. I also want to be clear about the risk. Any theme can become crowded. Any stock can move too far too fast. A good company can become a bad investment at the wrong price. A government program can be delayed. A contract can disappoint. A technology can fail to scale. A stock can fall even when the thesis remains intact. That is why the system matters more than the story. If you understand the system, you can size positions carefully. You can avoid being all in. You can wait for better entries. You can rotate when the money leaves. You can distinguish between a long-term theme and a short-term overextension. The goal is not to be emotionally attached to a stock. The goal is to understand the flow and respond rationally. If money keeps flowing into grid infrastructure, you want to know it. If money begins to leave and rotate elsewhere, you want to know that too. The market is a living system, not a fixed opinion. That is one of the biggest differences between amateur thinking and professional thinking. An amateur wants to be right. A professional wants to understand the conditions under which he is right or wrong. In this energy and grid infrastructure theme, the conditions are clear enough to monitor. Are data center power demands still rising? Are grid upgrade commitments continuing? Are companies reporting growing backlogs? Are power generation providers signing large customers? Are component suppliers showing demand strength? Are raw material suppliers benefiting from increased demand? Are the stocks showing relative strength compared with the broad market? If the answer to those questions remains yes, the theme remains alive. If the answers begin to change, I would change with them. That is how I think about it. I do not need to predict every political decision. I do not need to know every executive order in advance. I need to understand the pressures that make certain decisions likely and then watch whether capital is confirming the thesis. The executive order is important, but it is not the beginning of the story. The story began when the demand curve changed. The story became more visible when the stocks tied to the build-out began outperforming the order-added policy confirmation. That is a different stage of the same process. And this is why the opportunity is not simply about one administration or one headline. It is about a structural mismatch between power demand and power supply. AI is creating demand. The grid is constrained. The government is responding. Private companies are responding. Suppliers are receiving orders. Contractors are building backlogs. Markets are repricing the winners. That is the machine. And if you want to be a better investor, your job is not to argue with the machine. Your job is to understand it. The world is entering a period where the physical economy matters again. For many years, investors became used to software businesses that scale without much visible infrastructure. But AI changes that. The software layer depends on massive physical capacity. Chips, power, cooling, land, transmission, metals, generators, reactors, contractors, and skilled labor. The digital future is being built on physical constraints. That is a very important principle. Whenever the world becomes excited about something abstract, I look for the physical constraints underneath it. In AI, one of the largest constraints is electricity. If electricity becomes scarce relative to demand, the companies that create, move, manage, cool, and stabilize electricity become much more important. That does not mean every stock in the theme will win. It does not mean valuation does not matter. It does not mean risk disappears. It means the direction of pressure is clear. When I see clear pressure, public data, large capital flows, and a market that is still more focused on the shiny surface than the underlying bottleneck, I pay attention. That is what this moment looks like. The average investor is still looking at the AI chip. The more prepared investor is looking at the electrical system that allows the chip to run. The institutions have already begun moving into that layer. The government is now reinforcing the same direction. This is how major investment themes often develop. They begin as operational problems. Then they become spending programs. Then they become market trends. Then they become headlines. And then eventually they become crowded trades. The skill is to identify where we are in that sequence and act with discipline. For me, the lesson is not to memorize a list of names. The lesson is to learn how to see the chain. If AI needs power, who provides power? If power must be delivered, who builds the grid? If the grid must be built, who provides the components? If components must be manufactured, who provides the materials? If contracts are being awarded, whose backlog grows? If money is flowing, which stocks are confirming it? That is the framework. And once you learn it, you can use it far beyond this one theme. You can use it in defense, healthcare, commodities, infrastructure, technology, energy, and any other sector where pressure creates spending and spending creates winners. Markets are complicated, but the principles are often simple. Follow the pressure, follow the contracts, follow the backlogs, follow the money. Do not follow noise, do not follow emotion, do not follow the crowd after the crowd has already arrived. This grid and energy trade may continue, or it may become overextended in some names. That is why I would be disciplined. I would not chase every chart. I would not treat every stock the same. I would separate the high-quality contractors from the speculative names. I would separate companies with signed revenue from companies with stories. I would separate reasonable entries from emotional entries, but I would not ignore the theme, because when a country has an old grid, a new power shock, a government spending response, and private companies with urgent demand, the money does not disappear. It moves through the chain. The opportunity is to understand the chain before most people understand why it matters. That is the real lesson here. The AI revolution is not only about intelligence, it is about electricity. And if you want to understand where the next wave of money may go, you must stop looking only at the screen and start looking at what powers the screen. That is where the bottleneck is. That is where the spending is going. That is where the serious investor must pay attention.